Look at the stock market on any given day, and you'll find investors doing whatever mental gymnastics they need to justify the current prices. We see a line going up, and we invent a reason why it will never come down. Legendary investor Sir John Templeton, a man who averaged 15% annual growth for 38 straight years, had a warning about this. He called "this time it's different" the 4 most expensive words in the English language. Blind optimism empties a brokerage account faster than almost anything else. Jesse Livermore, a pioneer of speculative trading, put it another way. He said there is nothing new on Wall Street, because human speculation is as old as the hills. Whatever happens in the market today has happened before and will happen again. Right now, there is a historical market bubble that almost nobody talks about anymore. It's not the dot-com crash of the early 2000s or the 2008 financial crisis. It's a collapse from the early 1970s that looks disturbingly similar to the exact state of the market today. Understanding the mechanics of that forgotten crash is the single most critical blind spot a modern investor can address. The story starts in the late 1960s. The United States was riding a 20-year economic sugar high following World War II. Factories were booming, people had money, and suburbs were popping up everywhere. Americans had extreme national confidence. From 1945 to 1970, the U.S. stock market gained over 350%. This continuous bull run was driven by excess capital and the invention of massive consumer products. The U.S. had just put a man on the moon and, highly relevant to the average household, invented the Etch-a-Sketch. This massive climb in value popularized a new investing strategy. It was called the one-decision stock theory. The concept was simple. Invest in companies so powerful and dominant that you only ever had to make one decision. You buy them, and you never sell. These companies became known as the Nifty 50. They were blue-chip household names that generated stable cash flow, companies like Coca-Cola, American Express, and McDonald's. Investors viewed them as bulletproof. The idea of ever letting go of these shares was considered crazy. But whenever an asset is universally praised as a no-brainer investment with zero downside, it is mathematically transforming into a financial grenade with the pin already pulled. The price-to-earnings ratio measures a company's current share price relative to its actual per-share earnings. At the time, the market baseline sat at a humble, respectable 15. But the never-sell mentality warped their valuations. Coca-Cola traded at 46 times earnings, and McDonald's skyrocketed to 86. Polaroid topped the list on a jaw-dropping 90. Share prices completely detached from the actual cash these businesses brought in. Look at how that capital was distributed. At the peak, this small group of 50 stocks made up roughly 45% of the total weight of the United States stock market. The top 5 companies alone made up a quarter of the entire market. When half of an entire nation's stock market index is concentrated in a handful of companies priced for absolute perfection, the system becomes dangerously unstable. Then came 1973. Reality slapped Wall Street across the face as several macroeconomic dominoes fell at once. Oil prices quadrupled, inflation jumped to over 11%, and unemployment doubled from 4.5% to 9%. At the same time, President Nixon officially ended the gold standard, wiping out the last remaining illusion of absolute financial stability. Between 1973 and 1974, the broader stock market plunged 50%. It was the absolute worst bear market since the Great Depression. Panic rapidly replaced optimism. When the broader economy fractures, wildly overpriced stocks do not gently correct. They get obliterated. Coca-Cola shares fell over 60. 7 specific tech giants account for 36% of the market's weight. Put that right next to the 1972 Nifty 50's 45% concentration. The structural similarities are mathematically undeniable. Every time you put $1 into a supposedly safe, diversified stock market index fund today, you're actually making a heavily concentrated, unhedged bet on just 7 specific companies. This data visualization plots their current valuations. Google and Meta trade at 28 times earnings, Apple at 37, Nvidia sits at 50, and at the absolute peak, Tesla traded at a staggering 247 times its earnings. Are they highly innovative, dominant companies? Absolutely. But so were Xerox and Polaroid in 1972. Right now, investors are treating the Magnificent Seven as if they are completely proof, pricing their stock like gravity doesn't affect them. Warren Buffett summed up this exact phenomenon. He said, "What we learn from history is that people don't learn from history." We are staring at a top-heavy market, pretending that valuations don't matter, and waiting for the wrong macroeconomic dominoes to fall. And all the while, we are quietly whispering the 4 most expensive words in investing. This time, it's different.